So let's talk about dividends and a market downturn. This is probably the biggest question I get from advisors and investors across the board the most. All right. So this is resilience when it matters most. All right. So before we jump in, we got to define really what the difference is. So we're going to be talking about dividend stocks or income stocks. And these are stocks that pay a dividend. Then you have growth stocks, stocks that don't pay. All right. Pretty simple. We're just breaking them down. And you can break down the market into these two categories: stocks that pay income and stocks that don't. Pretty simple. That's how we're defining this, this lesson. So here's the question. I get some form of this question quite often. What happens to dividends when the market drops, falls, bottoms out, whatever? And I kind of get from two different perspectives. I'll get what happens to the income and or what happens to the price. Like, should I sell when the stock goes down? Because before investors turn into this type of mentality of dividend investing, they're used to buying low, selling high. They're used to volatility control. They're used to, let's get away from losing money. Most of us are bent that way. I get it. But once you start learning more about dividends, and there's this, I'm going to use this word tether quite often, things change. The mind of the investor, the dividend investor, definitely changes once you understand how they work. All right. So dividend stocks can, I'm going to use the word can because it's not definitively here. This isn't a marketing or compliance term. Dividend investing isn't for everybody. And most of the time, it will reduce anxiety and panic selling because of the tethering. There's something magical that happens with a dividend stock that tethers you to not making panic decisions, reducing your anxiety. Things happened so differently. I can tell you client after client story of times where the market just falls off or some crazy things happen, or I have one stock that drops and clients will call me up, email me saying, hey, I noticed this in our portfolio. Can I add more money? Most of the time, something like that happens. And clients will be like, get me out. What are you doing? I'm not paying you to lose me money. Our client base is a lot different. They'll be like, should I add more money to that? I see that it's down, which is so different. There's this tethering mechanism that takes place for here. Now, again, I just want to sum up one more time. It's not the magic bullet for everybody. It does work most of the time, but it should and can reduce anxiety and panic. So let's talk about the power of dividends here. And then we're going to talk about growth. So dividends, this is real recurring cash flow. So when I'm using the word tether, it's kind of like you're jumping out of an airplane and you're going to do a tandem parachute. You are tethered to somebody else, an experienced jumper who's been there, done that. All you have to do is just scream and be excited and, feel the wind in your face and look at your altitude and all this stuff and be present in the moment, because the person behind you who's done this 1,000 times is going to pull the chute when they need to, or make sure nothing goes wrong and you're going to land safely. That's kind of the same thing when it comes to dividends. There's this real recurring cash flow, this dividend that's a part of the stock. So with a growth stock, you just have the price and you want to buy low, sell high. With a dividend, you have cash flow. You have rent, you have payment, you have a paycheck, you have a bonus, whatever you want to call it. You have hard cash that gets paid on a regular basis. And if you do a really good job, you can see that certain companies have been paying forever and you can depend on it, even though it's not guaranteed. Another question I'll get. But the stock is more than volatile. It pays you. So there's a tether. When things get crazy, the reality is you're like, I don't want to sell it because I'll lose my cash. And as long as I hold on to it, I'm going to get paid. And once you start seeing the history of certain stocks, you're like, yeah, it's just a short-term deal. It'll come back. Their books, their cash flow, their profitability looks really good. This is just a market sell-off. I'm in no panic. Should I buy more? That's typically what you get when a client really understands what we're talking about here. All right. So here's a question for you. This will be fun. We're going to talk about the S&P 500. So the S&P 500, we're going to go all the way back to its beginning. It's over 100 years old. And the S&P 500, how much does the dividends, just the dividends, the dividend payments, how much of that represents what percent of the S&P? It's total return going all the way back. Now, you're going to wonder, you're going to answer all over the place. I don't really care what you say because I'm going to tell you what it is. But the naysayers here is like, yeah, you're going to give them this 100-year return. It's going to be X percent. But what's it been most recently? We're going to address that. All right. So what's the answer here? Is it 10%? Is it 4%? Is it 90%? You know, where are you at? The actual stated return here is 52%. Dividends represent 52% of the gold standard S&P 500. That means if you, and by the way, only about 67% of S&P stocks pay a dividend. So 2/3 of the S&P 500 pays dividends, and it represents 52% of the total return. So if somebody tells you that dividends are for old people, they don't know what they're talking about. If people say dividend stocks don't return, they don't know what they're talking about. Because all those flash flyers, those amazingly crazy growth stocks that don't pay a dividend only represent 48% of the return. And the dividend is a small portion. The typical return of a dividend, the dividend payment in the S&P is like less than 4%, and yet it represents 52% of its total return. There must be more than meets the eye when it comes to dividend total return. So now let's talk about the impact that the dividend has on the total return of a stock, okay, on a dividend stock. In a 1-year period, so at any 1-year rolling period, the dividend is going to represent only a quarter of its total return. Over a 3-year period, it could represent close to 40% of its total return over 3 years. Over 5 years, it's 42, 10 years is 48, 20 years, it's 60. And the farther you go out, the larger that dividend, that small, tiny little dividend. And you know why this is the case? Because that dividend is what props that stock up when things go really crazy. There's a trend in Wall Street that takes place. Here's what happens. When the NASDAQ is going crazy, everybody sits in the NASDAQ. And when there's volatility, a bubble, something crazy that happens, typically the NASDAQ is what's going to get sold off. All of that money flows into typical dividend stocks. So when the market takes a big dive, dividends get propped up and they hold their ground, and they're not shabby. They do pretty good long term. They actually outperform growth stocks because their bad years are not as bad as growth stocks. And then what you're seeing is this tiny little dividend that represents a small little return becomes such a greater impact because you're taking this return and you're reinvesting it at low points and high points and low points, and you're creating a much more larger share base, which compounds your return. That's why the longer you're in it, the more your dividend impacts your total return. This is why growth stocks can't hold a candle, can't compete on growth. A growth stock can't win against a dividend stock long term. It won't happen. I can show you case study after case study of where dividend stocks outperform growth long term. Most of the time, midterm, actually, most of the time, if not all the time, midterm. Short term is where growth can outperform, but not 100% of the time, which we're going to talk about in a minute. All right, so let's talk about investing $100 in the S&P since its beginning. So we're going to take $100, and if you invested that $100 in the S&P since its beginning, it would be worth, I thought I was going to make you guess. I already put it on the screen. It'd be worth $12,000. Now, that's on the growth side. You didn't reinvest, it's just the market. If you took the stocks and that paid a dividend and you reinvested those inside of the S&P, so you took 1/3 of the stocks or 2/3 of the stocks, the ones that pay dividends, you reinvest those, your 12 grand is going to be 174,000. Dividends make a huge impact. So if you have a buy low, sell high growth strategy, no dividends, you turn $100 into 12,000. That's a huge return. But it doesn't hold a candle to $100 reinvesting the dividends in the same companies, But instead of it just being the price, now you have the dividend that you get to reinvest. Look at how much more. 12,000, 174,000, not even close. Now, it took 100 years to get that. But look at the comparison of a growth stock versus a dividend stock. It's not even close. All right. Now, all of this research, if you're wondering where I got this from, go look it up. Why Dividends Matter by these two people. It is an awesome study on the importance of dividend impact and how fundamentally better dividends are as opposed to growth stocks. This is an awesome, there's so many studies out there. I love these stuff. I've got, I don't know, hundreds of them that I pull from to put all of this stuff together. It's what really impacted my life as well. So let's talk about growth stocks. This is where it becomes, I just talked about dividends. Now let's go to growth, because when you talk about growth, it's all about timing, when buying low and selling high. So from 2001 to 2020, so you got 20 years of investing. If you're fully invested in the S&P, an average, which averaged 7.5%. We had some bubble bursts, and we had this 2008. We had some pretty rough years, and we had 2020 in there as well. 2018 was another bad year. It only averaged 7.5%. If you just missed 10 of the best days over a 20-year period, okay? So the market averaged 7.5, or the S&P, if you were in it every single day, but craziness happens. You had 00, 01, 02. You had 08, you had 2018, and 2020. You had horrible years that cause people to do crazy things. If that was the case, and you missed the 10 best days, how much of that return do you think you lost? What would it be? Ready? It would have basically got cut in half, less than half. So if you're a really good investor, but you just missed 10 days out of 20 years, you would lose over half of your return. This is why investing becomes so difficult for a growth investor, because you have to make sure you don't miss the best days. 10 days, that's it. All right. Now, let's go over a 40-year period. Same study. You go from 1980 to 2020, so 40 years. Same situation, the S&P averaged 10%. Now, we're going to double. So over 20-year period, we only lost 10 days. Now, 40-year, we're going to lose 20 days. I should have figured out what the math is on how many trading days. I think there's like 230 trading days or something like that a year. So that would be a whole lot, 15,300 maybe. A lot of trading days over a 40-year period, and you only miss 20. What do you think your return would be? If you were invested over that 40 years, you would have averaged 10% a year. And if you just sold the portfolio for 20 days out of 15,000, I think, what would your return be? You ready for this? 0.5%. 20 days over 40 years. Like my brain can't even compute this. This is so against why growth investing is so dangerous, or so for. Like, this proves the point. Like the last one, you only lost 0.5%. You're losing 95% of your return here. If you lose, I mean, how crazy. What has happened in the last 40 years of the market over that 40 years? So many things. Would you have been poised to make, I mean 1987, 1990, 91, 90, oil, we had wars, we had terrorist attacks, we had bubble bursts. I think we're on the brink of another bubble. I think we have all kinds of things. And look, this is the people like, oh, don't talk to me about dividends. Talk to me about growth. Oh, that's old school. That's back in the 40s. Yeah, well, this is present. This is how dangerous growth can be. I'm not signing up for this. My clients are super emotional. That's why I love that tether. When you have that real cash flow, that tethers you to making more rational investment decisions. So let's talk about investor returns. This is the most important chart. This is a Dalbar study. Go check this out. Look up Dalbar. This it went, I think 2018. It was the first year they had 30 real years, not hypothetical, of actual investor returns. So we're going to look over 30 years. We're going to go 12 months to 30 years. And we're going to look at all equity. This is 100% stocks This is typically where you're going to have some kind of mix of stocks and bonds, and then you're just going to have straight bonds, and then here's the S&P. So over a 3-year period, the S&P has averaged 15, like chunks of 3 years. The market averaged 15%. The fixed income lost money. The equally weighted did 3.8. Now look at this, the all equity. How many clients do you have that are 100% all equity? I don't know an advisor out there that's like, hey, don't talk to me about that allocation. Don't talk to me about mixing things around, diversifying. Let's just go 100% all in. What advisor is given that type of speech? But to the actual investor only did 8.8% all in when the market did 15. That's pathetic. Most of your clients and my clients, if this is what I did for the growth investor, they averaged 4 when the market did 15. Next one up, 5 years, the market did 12.5%. This is where we're living. No, and you can check these out. Nothing there is impressive. But at the end of the day, I don't know anybody that's doing 100% equity. Okay? Over here, you're looking at 3.5, and the market's doing 12.5. Over a 10-year period, the market does 7, less than 2, 8. Over a 20-year period, 2%. 30 years, the market's averaged 10.5%. The average investor's done 1.65 in an asset-allocated diversified portfolio. You know why these numbers are true? This is actual return from investors. Go check out the Dalbar study. Don't take my word for it. This is their study, not mine. Done with real investors over a 30-year period. Do you know why? Because we're all normal. We all panic. We all are rational people. I remember during the pandemic in 2020 when I was scared to go outside in May. When everything shut down, I'll never forget when they canceled the NCAA tournament. I'm like, oh my gosh, this is real. And then we all had those stories, right? And I'm at the grocery store, masked up, gloves on, right at the height of the panic. And I'm going through the center aisle of where the soups were. And I didn't want to touch anything. I didn't know where germs are around. And I heard 2 stock people that were gloved up, masked up, and they were talking to one another. And I heard the one guy say to the other, I just sold out of my 401k. I'm sick of losing money. I'm done. That's what this is. People are just super emotional. And because we're emotional, when we have nothing tethering us to a stock, nothing tethering us to volatility because we're not getting paid, we tend to make very logical, emotional decisions which rob us of return. This is real. This is incredible. This is why I hated investing up until I learned about dividends. Dividends change everything for me and my clients because this is no longer a real study. And I tried to find a study that showed the difference in investor behavior between growth investors and dividend investors. It doesn't exist. And if you can find it, please reach out to me. I would love to see it, but I couldn't find it. I would even use chat and they're like, it doesn't exist. So if chat can't find it, it probably doesn't exist. But this is super awesome. If you're not convinced by this, just stop now because I'm done. So dividends versus growth. So let's talk really quick. Dividend stocks, stable returns. Like I told you, there's this methodology that happens in the market when there's growth markets are going up. There's less return in dividend stocks because a lot of that money gets sold out. It still returns, but a lot of that goes into the growth markets. And when things get shaky, the growth markets go back into dividends. So dividend stocks from a growth perspective lag growth when the markets are shift to growth. They still return very well, but they lag because all the big money is going into growth. On the flip side, when things go really bad on growth, all that money comes cashing into dividends. Growth gets crushed typically, and dividends either maintain or go up. I can show you years where the market's down 30% and good dividend portfolios are up 5 or 10. I can show you years in the market where the market's lost 30, 40, 42% and dividends are flat, down 5 or up 5. That's a huge difference. And then when the markets are up 40 or 30, dividends are up 15 to 25. So you're still getting a huge growth potential but hardly any downside. Dividend stocks typically don't lose a whole lot in any given year when things are even really bad because of that tether. More stable nerves because they have that tether, they have that dividend. Compound returns because they've got the dividend, it gets to be reinvesting, it's buying shares at all kinds of prices, income, cash flow. On the growth side, greater volatility, investor panic, simple return, zero cash flow. Why the Dalbar study is so true is right here. This is why people are normal. They're just acting how they feel and they're like, I'm done. But when you have dividend stocks, you're like, well, why would I sell? I need my income. It's like saying, hey, I don't like my job. I love my paycheck. I don't like my job. I'm just going to quit. Well, how are you going to make your bills? I don't know. That doesn't make any sense. Like, you're not going to quit your job until you find a better one. Or when it comes to investing and you're getting paid over here, you're not going to sell. When you're not getting paid over here, nothing's holding you in. So you're like, I'm out. I don't want to lose any more money. Here you're getting paid. You're like, am I losing money? I don't like to look at my balance, but I love to look at my bank account. And, over time, I've noticed that the stock just keeps growing and growing and growing. So, income potential. Clear winner. There's no income over here. There's literally nothing. On the historical performance, which I've shown you, dividends make a huge impact on total return long term. It's the reason why the S&P is the S&P. 52% of its total return is represented in just 2/3 of that index. Clear winner. Total return over time. Clear winner. Here's the short term. It's the only thing that we can argue is not the clear winner. It still wins 40% of the time. Growth will win about 60% of the time. Short term is like 3 years or less. The longer you go out, the more opportunity that dividends are going to win. The shorter the time frame, and growth isn't always going to win, because I can tell you if it's a 2022, the bubble burst 2008 or 2008, 2000, 2001, 2002, dividends crushed. Wasn't even close. So if you look at certain periods, I can tell you that dividends have crushed growth in 1 year, 2 year, 3 year. Like in 2000, 2001, 2002, dividends absolutely annihilated growth. Growth was down 55%. Dividends were up like 15, like 70% return difference. But I can show you another 3-year period where growth, beat dividends by 35%. So it really depends on what. That's why it's 40% of the time versus 6. But this is really short term. Like we're talking 6 months to 3 years, 1 month to 3 years. All right. Dividend stocks tend to change investor behavior. This is that tethering mentality. I've said it this whole way. I don't want to keep beating it down. Dividend stocks dominate investment income and market return, total return, without a question. The clear winner here is dividend stocks. And if you don't believe it after watching this, go do your own research. I mean, this has been littered with so much great research, this presentation, this lesson. Go do your own. You'll come to the same conclusion that I did, because I wasn't a believer when I first learned about it. I was interested in it. I didn't have any reason to not believe it. But the more I learned about it, I'm like, oh my gosh, this is amazing. Last thing I want to go over, we're going to be done. If you want to dive into more content than what I have on this online for free, because you can get in just about everything that we teach for free. I give a lot away. I love teaching advisors. I love teaching our client base. We have tons of education. We have a few paid programs. One of them is Advisors Ascend, where you have to buy it. It's kind of like drinking from a fire hose. It's everything our office does, from planning to investment strategy, building portfolios, how you plan out your days, how you run your business, how you become more profitable. Advisors Ascend is one of those programs. We do sell it online. All you have to go to is advisorsascend.com. You can learn all about it. Check out a free preview and get into the course without paying anything and see if you like it. There's a money back guarantee. If you don't have to pay for the preview, but if you buy it and you don't like it, you can get a refund. Check that out. It's one of the only things that we actually charge for. You can just continue watching our videos for free. You don't have to do that. But we put a lot of free content out, and that's being the only paid one. So I hope you enjoyed a lot more about why dividends are a far superior investment vehicle than growth stocks.